Hello and welcome back to Pay Down Debt Solutions. My name is Jen, and today we're going to be going over some more mortgage situations, some more mortgage scenarios with you. And I had a really great student scenario that I wanted to bring back and show you guys. It was one from a few months earlier, but I thought today would be a really relevant day to bring this up because I promised you guys that I would kind of go into some more of the mortgages. But this time we're going into the mortgages and debt combined, right? So I know I've talked to you guys about velocity banking when you have a mortgage and you have debts, and to take care of your debts first, okay, aside from the mortgage. And most of the time, that's something that you should do, especially if you're new to velocity banking. But if you guys can handle it, and depending on your situation, depending on that situation, we can do both, okay? Because what velocity banking is, and when you involve the mortgage, you guys want to cancel interest, right? That's the whole idea behind velocity banking is canceling interest, all right? So velocity banking, your mortgage and your debt together, you can do it. And it also depends on your situation. So can you? Yes, you absolutely can. Should you? Well, that really depends on you, and that depends on your situation. Now, I talked to you guys in the last video I did about how I was stressed out when Dan and I first started velocity banking, okay? And when had all the debts that we were in and we were really trying to figure this out. And I was learning all about velocity banking at the time, okay? And what happened was I started to get really stressed out about my mortgage because I know that the mortgage is a wealth stealer, all right? You guys, it is an absolute wealth stealer. So when you look at this, right, if you look at Jimmy and Kelly and how much their mortgage is going to cost them in interest, all right? $377,698 in interest alone is what it's going to cost you. So you guys, your mortgage is a wealth stealer. Do you want to have a house? Absolutely you do, 100%. I want to have a house too. But knowing that, okay, knowing you want to have a house and knowing how much your wealth it's going to be stolen from you, right? This is when you have to start getting smart and start thinking on a whole different level. So those of you out there that are still doing the traditional banking, okay, you found this channel because you are looking for a way out of your debts, all right? Maybe you're sitting in a mortgage, and if you are, this is a great video for you. If you're not sitting in a mortgage, still a great video for you because we're going to work with debts and our mortgage, and we're doing it a little bit different. Because when we talk about canceling interest, okay, you guys have to start getting really smart. And so part of that is learning how to think outside the box. Now, everybody talks about thinking outside the box, but this is a real serious way we can think outside the box, right? And when we talk about canceling interest, we need to start thinking about all sorts of different ways you can do that. And what am I going to bring up? Probably one of my favorite things, which is the 0% credit card, right? Doing balance transfers. So if you're like Wendy and Jim here, okay? If you're like Wendy and Jim and you want to be able to, and you have the ability to have a 0% card and to use it, I'm going to show you a way you can take care of both your debts and your mortgage simultaneously, and why you might want to do that when we take a good look and take a deep dive into these numbers. Now, for those of you that don't know me, my name is Jen. You will also see my husband, Dan. He also runs videos. He's got one for you. And I know I said that in the last couple of videos, but he has been really busy with one of our other businesses. So he is going to be here this week with a really great student scenario for you. So he will be running that video shortly. But for those of you that don't know us, we are business owners, okay? And so we got ourselves into a whole world of hurt a few years ago, okay? Well, it was accumulated, right? It accumulated over a few years, but we found that about 4 years ago, we were really in a pinch, okay? So we were really tight, and we actually consulted with a bankruptcy attorney because we thought, okay, well, we had some money and we really wanted to hang on to it. It was from a sale of our business, and we didn't want to give away that money if we could avoid it, right? So if you all remember back in 2008, when everybody was, ditching their mortgages, they were filing for bankruptcy, and they were all walking away from their homes and getting that bigger, better house, right? And I always thought at the time that that was pretty miserable, but here I was, a miserable thing to do, right? It was just a terrible thing to do, to take advantage of the system that way, right? But here we were thinking about it ourselves, right? Because we were in a situation where we felt really tight and we wanted to hang on to our money, but we didn't know how to get out of debts, right? We didn't know what to do. And so when we consulted with that bankruptcy attorney, we realized that was the worst thing that we could do. And for a number of reasons that the bankruptcy attorney went over with us. And he was actually a pretty good guy. Okay. So he was a pretty good guy. He really sat down and kind of dug into it. And he's like, if you guys can find another way, try to do that, because it opens you up to a whole can of worms when you file for bankruptcy. You guys, it's not the easiest way out for sure. And some people think, well, I'm going to just wipe myself clean of everything and I'm going to walk away from it all and I'm going to, put that behind me and I'm going to move on. Well, you can't move on when your credit is trashed, right? You really can't, because bankruptcies will destroy your credit, okay? And there's different types of bankruptcies, and some you can walk away, after, selling everything and, completely walking away from everything. Others, you can keep your home, right? And then there's other things that you can do, but you never get away with not paying anything. And I think a lot of people think that sometimes, but you guys, that's not the case. And so I'm here to tell you that if you are faced with a situation such as a bankruptcy, you have a way out. And that way is velocity banking. Had I not found velocity banking, I don't know where we would be. I'm not really sure, but I did, right? And so a little bit about my history, okay? So yes, Dan and I are business owners, okay? And we have multiple businesses. I have some online businesses. We have brick and mortar businesses. We have delivery businesses. So we've had a lot of different businesses over the years, okay? And what happened was we started them up probably too fast, okay? So we ended up in these debts. But as a business owner, okay, something that I learned, which really went great with my banking experience. So I am also an ex-banker and an ex-branch manager. So 14 years ago, okay, so I was in banking for 13, almost 14 years, and branch manager and a banker. So I understand all these banking tools that I've been introducing to you. And of course, a lot of you understand, obviously, credit cards and you understand loans, but not everybody understands exactly these different lines of credit that are available. And it is the line of credit that works in harmony with velocity banking, because we would not have velocity banking if we didn't have lines of credit. So we also call them revolving lines of credit, or RLOCs, okay? So if I slip up and say RLOC, that's what I'm talking about. I'm talking about revolving lines of credit, such as a home equity line of credit, a personal line of credit, and yes, the wonderful credit card, right? And I say wonderful because they can be, and they are, if you know how to use them the right way. So that's what we are here. That's why Dan and I created this channel, was to teach you the right way to use lines of credit and to show you that when you use them the right way, how beautiful you can turn a really bad situation into a really great situation, okay? So they do some wonderful things for us. And one of the best things that they do are revolving lines of credit are the interest on them is simple interest, okay? And that is figured on an average daily balance, all right? And it's the average daily balance that allows us to velocity bank, or bank with velocity, and get ourselves out of debt, all right? And I will go over that for you when I show you the student scenario that we have here, and we talk about our debts and how we figure out how to use velocity banking and how we're going to get them out of their debts faster, okay? So long story short, Dan and I, ended up finding velocity banking. We got ourselves out over, $90,000, okay? So it was a lot of money. So we got ourselves out of $90,000 in rapid, quick time. I would have never guessed we could be out so fast, because had we been sitting in loans, that would have never happened. We would have never done it as fast as we did if we were sitting in loans. Always align, never alone, okay? Always align, never alone. It is because, again, of that simple interest. Loans are calculated on an amortized schedule, right? Such as this, okay? So this is part of the scenario that I'm going to be going over today. But you can see this is actually their mortgage schedule, and it is amortized. So what does that mean? That means that your payment is going to always remain the same. But what's different is inside of the payment, okay, you have interest and you have money going to principal, all right? So as you can see, in the very beginning of your mortgage, right, the very beginning, you are going to have a lot of money that is going to your interest versus what goes on your principal. And this is a timing thing. So this actually over the course of that year was more than the 19,055. It was higher, but it's timing. Okay. So we know that our very first year that we're in our mortgage, it's going to be a lot higher in interest and less in principal. And you can see, you guys, there's a huge disparity, isn't there, into how much you're paying for principal and how much you're paying for interest. Look at that. 2, 4, 6, 8, 10, 12, 14. Look at that. 7 times, right? I mean, think about that. So we're at $14,000 in interest that we're paying that year, and we are paying $25.81 towards our principal. Kind of makes you sick when you think about it, right? So that means they're going to start their balance here when we do this. We're actually starting at $300,563. All right, but again, so these payments, right? So when you make your payment and you're on an amortized schedule like that, the majority of your payment is going to interest, especially in the first 10 years or so, like a mortgage. Okay, so the majority is going to your interest, and the lesser amount is going to your principal. And that becomes inverse, though, right? It's an inverse relationship. So as your mortgage moves through time, okay, your interest gets less and less and less, and your principal gets more and more and more as you move through. But why is it designed that way? Why do you think? Because the banks know that people move between, in the first, I think it's like 3 to 7 years. Okay, so people move or they're going to refinance their mortgage. Okay, so they're going to move or they're going to refinance and think they're going to take care of or take advantage of better rates, or maybe they're refinancing to get out of some debt. Maybe they're pulling cash out to refinance and get out of some debt. So the banks are really smart. Okay, so they do this because they know that they're going to get a big chunk of money from you up front in interest. And then they're going to do it all over again when you refinance that baby, or you move and you get a brand new loan, right? So they're really smart. And so we need to outwit them. And that is what velocity banking is all about. It's about outwitting the traditional banking system, because we can, and because you can and you will when you learn velocity banking. Now, do we need banks? 100%, absolutely. We 100% need banks. So I'm not trying to put the banks out of business, but what I am trying to do is let you guys win over the banks, and you keep your money versus the banks keeping your money. You keep your wealth. Don't give it away to the bank in interest. Look at this. In 1 year's time, 1 year's time, 1 year's time. Think about that. That's a lot of money that you are giving up in interest. Okay, so velocity banking your mortgage and debt together, okay? Interest canceling. That is what this is all about, is canceling interest. Sometimes you have to just take care of your debts, right? Sometimes you just have to do that first and not include your mortgage. But if you're in a position where you can, such as these guys were, then you can go ahead and do that, so long as you kind of understand and learn. Keep watching, you guys, keep learning. So let's talk about this. So here we have Wendy and Jimmy, and they did come to us, and they wanted to get themselves out of debts. They had found velocity banking. They tripped across our channel, and they liked our style, so they started emailing and asking us some questions. And so eventually we did a one-on-one coaching with them, and we showed them a way that they can cancel interest on their mortgage. All right, so here's what we've got. We've got an income for these guys of $67.08, okay? And we've got total expenses of $63.98, which means they have a cash flow of $310. So they do have positive cash flow. Their mortgage at this point in time, because they were almost exactly a year in, okay, it was $300,563. The payment on that mortgage is $1,008.91. I keep saying that. $1,008.91, and their interest rate right now is at a 6.375, and it is a 30-year mortgage, which means that by the time they are done paying this off, okay, in 30 years, they would have spent $377,698, and they would be giving it to the bank. Thank you, bank, for allowing us to use your money to purchase our home, and here's an extra home for you, because we just gave you that much in interest. That makes me sick. All right, anyway, so now we've got one of their cars, okay, and I believe this is a Jeep, so for all you Jeep lovers out there, they have a Jeep. And this was $26,144, all right, and they owe $494 a month on that, and that's at a 5.125%, 5-year loan, And at the time, if they pay this back, right, paying this back, traditionally banking, it's going to be $35.48, okay, in 5 years' time. Car 2, we're sitting at $38,695. It is at a 726. I think this is a truck. It's at, I don't know why you care, but I do. Anyway, so 626, and it's at a 4.75% for 5 years. And so that, to term that out, is going to be cost them $4,852. Okay. Again, these are amortized. So they're front end loaded. Okay. So all of those are front end loaded. Now, we've got a quick silver card at $84.61. $282 a month is what they're paying for that at a 28% interest rate, which means it's at, to pay it all back, all right, it's going to term out at 4.9, almost 5 years, right, for $62.06. So look at this. Credit card costing more in interest, even though the balance is itty bitty, right? So again, while this looks like this is a good deal, maybe, right? Might look like a good deal. We know that in most cases, it's not. And even if you get a deal like this, you can velocity bank your way out of it for much faster, right? Once you learn this new skill. Okay, so now now we're at the 6206, right? So now we've got a Discover card for $6,291. It is at $188 a month for 24% is their interest rate. And really, their interest rates really aren't that bad when you think about it. This one's high, but this one's not. Sick that we're saying that 24% isn't high. Right now, rates are ridiculously high. We're seeing 32%, you guys, 32%. So, I'm taking this all day long, maybe, right? Maybe, but that also depends on what the internal workings of that card are, and that is for another video. All right, so at 4.8 payback on that, 4.8 years, and that would be $4,179, okay, to term that out. And we've got a home equity line of credit, okay? So home equity line of credit is kind of our shining star in this, right? So this home equity line of credit is for $2,310, okay, that's the balance that they have on it. It's $43, I think it's interest only, and it's at 10.25%, and I forgot my percent, you guys forgive me. And to pay that back would be a year, right? So not much time. Now, why is this a shining star? Because they have this home equity line of credit for the line is $19,500 and it's at the 10.25%. So we talked to Wendy and Jimmy, he goes by Jimmy. We talked to Wendy and Jimmy about doing this, pay down of their mortgage, right? And so I had a suggestion for them because, as you can see, their home equity line of credit is $19,000. It's under $20,000, okay? And so it's not like we can put these cars on that line of credit, can we? We really can't do that, okay? So the debts that we can pay off, though, are these three here, which I have underlined. But if they want to get ahead on their mortgage, what could they possibly do? Remember, you guys, it's about thinking outside the box. So we took a 0% credit card, okay? It was a 0% card. The limit was $12,000 and it was 0% for 15 months. The convenience check on that was a 4%, but we decided we were going to take $10,000, okay? So we're going to take $10,000 and we were going to slap this against their mortgage over here, okay? So why do we do that? Why did we do that? Well, we're going to talk about that in just a minute. All right. So here we took this $10,000 and we're parking it. We're going to park it until we work some of this down, okay? So why would we do that? We would do that because we want to save ourselves as much interest, right, as possible. So it's going to sit there. And the payment amount on that is going to be 1%. So it's going to be $100 a month, all right? So here's what we have going on. So we took our debts, our three debts here, the Quicksilver, the Discover, and the home equity line of credit. We packaged them together and we put it on our line of credit, okay? And the total on that was $17,062, all right? So this is number two powerful thing about velocity banking, right? Number one is using lines of credit and the simple interest, right? The simple interest. And two is our income in and our expenses out. So when you do velocity banking, you are learning a skill and you are learning something totally different than what you have been taught. You have been taught to put money in your checking account, you're going to leave it there and you're going to pay all your bills out of your checking account like that, right? It's like, cards at a casino, right? You're paying them all off, right? But when we use lines of credit, we do things a little bit differently. Our direct deposit comes into our checking account for about a second. Don't blink or you'll miss it. And then we're going to make a payment to that line of credit of our entire paycheck amount. Oh my gosh, Jen, why would we do that? Why would we do it? Because, again, when we bring our check and deposit, our direct deposit into a line of credit like that, because lines of credit are figured on an average daily balance, we are immediately dropping our balance to $10,354. What do you think that does to your interest, right? What does it do to your interest? Well, this is your high interest rate amount, right? This is your low interest rate amount for that day. And now we're going to average it. So it will be lower than it would be, right? We know the interest rate over here remains the same always, but here it's a little different. It works a little bit differently. So now we take these two and we're going to average our interest, right? So how do we figure out what our interest is? Well, we take our high balance, and I'm skipping over the expenses for a second. We take our high balance, we take our low balance, and we add them together. We then divide it by 2, okay? So for all of you newbies out there, and I'm going to bore some of you, whoops, there goes my purple marker. I'm going to bore some of you for just a second, and my apologies, but I want to make sure people understand this, because my job, I am not doing my job if I do not teach this to you, because this is confusing stuff. It can be, right? So we're going to take the $17,062. We are going to add $10,354 together, and that gives us $27,416. We are then going to divide that by 2 to get our average. So now our average is $13,708, okay? We've divided that by 2. Now we have to multiply it by our interest rate, okay? So that is going to actually be multiplied by 0.1025, all right? And that gives us $1,405, so $1,405. Well, that is for a year's worth of interest, but we only need 1 month, don't we? Because this is the only month it's going to sit there like that. So we're going to divide that by 12, and then it gives us $117 for 1 month, all right? So here's our 117 that we figured by averaging it out, okay, what we're going to pay on that home equity line of credit for that month, that first month. Now, our expenses of $59.85. Okay, so $59.85. So what we do, how do we get our expenses? How do we know what our expenses are? Now, lines of credit. Beautiful thing about lines of credit. We don't owe this payment anymore of $43 because we are putting all of our income into that line of credit, which means we have satisfied this payment here. So we don't owe it. We don't owe it. We don't owe that at all. The other thing we've done is we've paid off the Quicksilver and the Discover card, right? So these payments we no longer owe. So these are gone, right? So these are gone here, and this one is gone too. So now, how do we figure our new expenses? All right, this is how. So we take the $63.98 and we're going to subtract off $282. We're going to subtract off $188. We're going to subtract off the $43. And it's going, whoops, I don't know what I did there. Hold on, sorry. I fat fingered something. 6398. We're going to subtract off the 282. We're going to subtract off the 188. We're going to subtract off the 43, which gives us 5885. Okay, now, but I have 5985 right here. Why do I have that? Why do I have that? Well, remember, when we parked that money on our 0% card, we owe something. You can't just park it there and not make a payment. You have to make a payment. Now, when you have a 0% card like this, it's going to be somewhere between 1% and 3% as your monthly payment amount. A lot of them are 1% because that's kind of the point, is to park money on these cards, right? Some of them are higher, but a lot of them are 1%. This one in particular was 1%, so they owe $100. So now I'm going to add back in $100, and that gives me obviously the $59.85. So that is our new expenses, okay? So $59.85 plus the $117 gives us $16,456. So our new month is $16,456. So we started out with $17.62. We're back to $16,456. Well, after the income came in, right? dropped us to 10, but we have to add back in these two, the expenses plus the interest, to bring us back to 16,456. So we do a check here though. At this point, we want to do a check because we have to make sure we're going in the right direction. Because if this is higher than this, we got a problem, right, Houston? We've got a problem, that kind of thing. So we have to make sure that this is less than this, okay? Doesn't mean, now, when you do velocity banking, the great news is you have breathing room. And if something happens and you have an extra expense and that does go up for a month, breathe. It's okay. You're going to continue to work it back down. It will be okay. But this gives you a place to go, okay? All right, so we're at 16,456. Again, our income comes in, drops us to the 97.48. Then our expenses plus our interest, and as you can see, our interest is lower, right? And it continuously drops. Now, this goes on for 17 months. But at 15 months, right? At 15 months, our card is now due. Our interest is now due on our card. So we have to do something about that, right? So we have to do something about it. Well, we now can move it, all right? And we're going to move it then to that home equity line of credit. But our home equity line of credit balance is at the 15-month mark is at 7,401, right? So then we're going to add our 8,500. Okay, so 8,500, where did I get that from? Well, I know that says 8,900, but where did I get this 8,500 from right here? Well, $100 a month for 15 months, right? Takes 10,000 down to 8,500. But we also have our convenience check fee. Where did I write it? Our convenience check fee, which is 400. So if I add that in here, it's going to be $8,900, all right? So now we started all over again at 16,031 or 301, right? So 16,301, again, our income comes in, drops our balance to the 95.53, all right? So remember, this is after 15 months time. To finish this off, it would have been 17 months, but at 15 months, we're bringing the card in, right? So that's why I have 17 months here. And that is why at the 15-month mark, we add these together, all right? So, sorry, side note. So 95.93, we then add in our expenses. Hold up, wait a minute. We've got 8,558, but here it was 59.85. Why is that? Well, remember, we moved the money over from the card to our home equity line of credit, so we don't owe that payment anymore. So you can subtract off the 100. So now we are working with 85.58 as our expenses, right? And then again, our interest comes in. You know how to figure the interest now. Okay, so why did I bother to do all this? And what does this do for our students here? What does it do for them? Well, let's think about this. Remember, I showed you that our mortgage here is going to cost us a whole lot of money, right? If we let it term out over 30 years and we don't do anything about it, we are going to spend $377,698 to term this out. The anxiety for me was enormous at this point, right? Because I know every year that goes by, I'm losing out on money. My wealth is being thrown out the window, right? Look at this. So they're throwing out $14,000 here, $19,000 here, $18,000 here. So when we put that $10,000 chunk onto this mortgage, right? When we did that, what happened? We skipped ahead in the payment schedule for that mortgage. We shaved off 2.5 years worth of time and interest payments. So in this 2.5 years, here's what happened. So we're going to take this off and we're going to show you. So if you add up those interest charges, okay? Sorry, I'm anal. I have to put this away. All right. So if you add up these interest charges, you're 19, right? Because we saved this year and we saved this year. Here's the two. And about halfway through this year, I just split it in two for ease, okay? For ease, I didn't want to calculate it all out, so we just split it in two. All right, so for ease, I split it. So now we have 1955, we have 18,817, and we have 9,281 for a grand total of $47,153. And it cost $400 to do that, right? You just saved $47,000, right? In one move like that, in a 0% credit card, okay? And I know you're sitting there saying, yeah, but you have this 0% credit card, you had $15,000 parked on it, you still, put the money back here, right? You still took it and put it back onto that home equity line of credit, so you're paying interest there. You're right. You're right. But how much are we paying? How much? So here is what happened. And this took a total of 28 months, okay, to do. But in that 28 months time, we saved ourselves $47,000, right? So did we really though? Did we save ourselves $47,000? No, we saved ourselves about $37,000 because when you take and look at what we spent, okay, we spent 11, to do the first chunk here, okay, over here, to do this first chunk in 17 months, well, it actually ended up being 15, remember, because we added the other one. We spent $1,184. That's it. Look at, for that dollar amount, the 1762, look at these. Look at these. Look, this was 62, right? This was 41. Well, this doesn't count. This is 48. For this dollar amount, we spent $1,184. But we aren't done because we still had the chunk from the $15,000, the $10,000 that we parked on our 0% card. Well, that's represented here for the $940. Okay, so you add those two together, we get our $2,124. Okay, so $2,124. So 1184 plus the $940 from these two, and now we have to add the $8,400 for. I'm going to cover this part up for a second because I wanted to not confuse you guys. So we spent $2,124, okay, to save ourselves $47,153. So what is that? So 45 or so, 44, almost 45,000 that we saved just by doing this move with the 0% card. You guys, this is really powerful. This is all about interest canceling, right? All about interest canceling. So if we let all this term out, right, and you still have these two, the car loans here, right? So we have $8,400 in these two together, all right, which is ironically, it actually worked out to be $8,400, right? So when you leave these go, you let these go, okay, and term out. So it's going to cost $8,400. And if you add that $8,400, okay, together with the $2,124, we're still saving, okay, we're still saving $37,000. We're still saving $37,000 on this, all right? Because this you're going to have to pay anyway, but it's insignificant when you think about how much you've saved over here. So $37,000 is what you have now saved in 2.5 years worth of time. Now, what's great is, here, let me put this away. All right, so now let's hold that thought for a second and we'll go back and we'll look at this. Okay, so why do we do this then, right? So why? Why do we do this? Because when you want to cancel interest, and if you have the ability to cancel interest like these guys did, all right, you can do this over and over and over again, okay? You can rinse and repeat this with a 0% card at 15 months and you're going to spend $400 to do it. 400 bucks. And I'll tell you what, almost every credit card that I have worked with that's a 0% card, the minute I get down to paying that card off, they're already offering me more 0%. They're trying to entice me to bring money back over. So this card more than likely is going to offer them another round of 0%. So they're going to then do it again. They're going to slap another $10,000 and they're going to move ahead in the schedule again, okay? Now, this is the most impactful time to do this, right? Especially in the first few years, because you're going to have the most savings when you do it this way in the first few years. The savings then becomes less as time goes on, but it still cancels so much interest for you. If you can do this a few times, right? And use 0% cards to do it and work those cards off then with their home equity. Because look, when these are done, right? When these are done being paid, now we have this $1,200 back in their pocket that they can start hammering down this mortgage with greater and greater and greater intensity. And as they pay down their mortgage, guess what happens? They have more equity, right? Their equity that they have in the home increases because they're obviously paying their balance down. So then they can get a line for much larger if they want. So maybe instead of doing $10,000 chunks, they can do $25,000 chunks and save themselves even more money. So you guys, this is why we learned velocity banking, and this is why you make that combination and you make that connection, right? You think outside the box and you use combinations in velocity banking. That is what we're here for. That is what we're here to teach you. And we do this every day, you guys. We do this every day. We think outside the box with our students and we teach them these skills. So learn velocity banking. Save yourself a whole lot of money in the long run. Have an awesome day, you guys, and I will see you in the next video, but it might be Dan. Have a good day.